Bloomberg Audio Studios. Podcasts, radio, news.
You're listening to Bloomberg Businessweek with Carol Massar and Tim Stenovec on Bloomberg Radio.
Well, President Trump has threatened a 200% tariff on all alcoholic products shipped from the European Union, dismaying drinkers, restaurateurs, bar owners, and suppliers across the U.S. A reciprocal tariff-free trade agreement that has existed between the EU and the United States since 1997 could be ripped up as a consequence of Trump's anger at a European levy on America's native spirit, otherwise known, Tim, as bourbon.
Well, we are very interested in how the U.S. spirits industry is viewing all of this. Allie Anderson is CEO at CraftCo. It's a company that has more than 24 spirits and liqueurs, including gin, vodka, bourbon, rye, and ready-to-drink cocktails. She joins us from Alexandria, Virginia. Allie, good to have you with us. How are you?
I am well. Thank you, Carol. Tim, good to be here.
Hey, before we get to exactly the impact of tariffs, explain your portfolio here, because I want to understand what exactly you have, if you make it or if you just license it. What are the intricacies here?
Oh, great question. Great question to start with. So CraftCo has 5 different brands that are distributed all across the United States. We make these brands. We do source our whiskey. We distill our gin and our vodka. We've got everything from the value end of the spectrum, or if you're just trying to get into whiskey and you're not quite sure where to start, all the way up to ultra premium luxury whiskeys that we spend quite a bit of time blending and finishing. So there's a lot to dig into with our portfolio. We also have a range of RTDs, which are very popular right now.
The ready-to-drink cocktails.
Yeah, ready to drink. Great. Yeah, canned cocktails could not be bigger right now. And they've been on the climb now for a couple of years. So we've got those as well. And then some liqueurs. So if you're just, into the the lifestyle thing where you're not interested in 100 proof whiskey, we've got some liqueurs that are very flavor forward and lower proof. So you can throw them in your seltzer and still be able to enjoy a good time.
So I'm wondering about the tariffs and how you're viewing this. Do you export at all?
We currently don't export, but here's the thing about tariffs is that they affect everybody, whether you export or not. In fact, this was going to be our year to start exporting. So naturally, we're disappointed here at CraftCo. We're in 42 states right now, and that's definitely affecting us. I think, when we talk about tariffs and think about it, we first of all commend the administration's objectives to protect the American people, to support jobs in the United States, but we are concerned that those tariffs just really don't contribute to that effort. In fact, we think it harms the American jobs. You look at something like whiskey, right, which starts with the farmers who grow the grain, and we're very connected to that process. And then you move to the small business guys like us who distill that grain. Then you move on to the distributor whose trucks take it to your favorite bars and restaurants, and eventually that bartender that you've got a relationship with, where you go to get that great dependable glass of whatever your spirit is. Those are all the people in the supply chain that are really affected by this, whether you export or not.
So you were going to export this year, but because of tariffs, you're not going to?
That's right. Yeah, we were going to export to Canada and to the EU. And certainly now, of course, we have to pivot, and that's what we do. We're a small business. We can absolutely do that. But it does create a lot of price pressure and certainly a lot of competition at the shelf that the over 3,000 small distillers in this country now have to contend with. Where's all that supply going to go? It's going to come right back here to the United States.
Yeah. How much has that changed then your business story and how you think about 2025, Allie?
Great. Yeah. So what it does for us is it really concentrates what we do at home. So we're based out of Holland, Michigan, right there on the lakeshore. We're super proud of it and we love it, as are the Michiganders all over the state. And so what we do is we're concentrating our strategy to be experience-based. So we're going to reopen our tasting room here very soon, and it's going to be an experience where you can come, you can sit down, you can connect, you can talk maybe about how tariffs are hurting your business. You can celebrate the best of what we have, which is an American spirit.
Well, it's interesting too. The whole story of tariffs, it's obviously changing your plans for going overseas. There are concerns, though, that, all of this ultimately is going to impact, as you said, this impacts farmers, drivers. So many people get impacted potentially by tariffs and not being able to access markets outside the United States. Are you beginning to think about a slowdown in the U.S. then as a result? Are you beginning to think about a possible recession and making business plans for such?
Oh, we certainly are. I think, we've seen a lot of the, what we do at CraftCo is we look at the broader context. And so we're seeing the larger producers start to pause production. We haven't seen that for many, many years, right? We had this huge bourbon boom going back to 2005, all the way up through COVID. We've all heard about the whiskey glut and the COVID hangover, and things are slowing down. And in the industry, we call that normalization. So we very much see this as cyclical, not structural. We've certainly weathered tough times in the spirits industry before. But to your point, Carol, like it really is the hardworking Americans, the corn farmers, the truckers, the distillery workers, the barrel makers, the bartenders, the servers, the communities that ultimately depend on this for economic reasons, but then also just to connect, right? To connect communities. I think it's gonna be a tough road.
Allie, is there a belief, and I think this is something certainly everyone across the U.S. and those of us who report on policy out of the White House are trying to gauge, especially since as tariffs have been talked about since President Trump came back for a second term, we've heard things and heard, something different potentially an hour later or the next day. And so it's fluid is how we are describing it. Is there an expectation that potentially this is a shorter term thing and that ultimately overseas markets will reopen again? Or is there a concern that other markets are getting nervous about what the U.S. is as a trading partner and will look for longer term solutions to get, whether it's alcohol, whether it's their bourbon, whether it's what have you, in the future? I'm just curious if you can game that out.
Yeah, it is. It's a game of ping pong right now.
Yeah.
I think that's why. So we take the stance, at least in our small business, of being flexible, of rooting down into what we can do domestically right now. And we've got a fantastic distribution network. We really do have good partners that way, but they're experiencing pressure as well. One of the other things I think that's really interesting about this is that spirits is unique in that you can't make tequila or bourbon, which are very designated, distinctive products that can only be produced in certain geographical areas around the world.
Good point.
That's very unique to these. And to even argue on the other side of it with champagne and with cognac and Irish whiskey, right? Like, so it really is something that affects all of us. And I think generally in the spirits industry, we're all very cooperative. I think we've been the model for what is fair and reciprocal trade, 0 for 0 tariffs, as you mentioned at the top, since 1997. So that's, we've done it well. We've done it right. We hate to see that get broken.
What would you say to somebody listening or watching right now who says, wait a second, if we put tariffs, the U.S. that is, 200% tariffs on all alcoholic products shipped from the European Union, shouldn't you embrace that, Allie, because you're an American company and then you don't have to compete price-wise with the imported gins, the imported vodkas, the imported spirits?
Yeah, I can see where that might be the case. I think for us, a rising tide raises all boats. And that is something we've done for a long time. It's something we believed in. Competition is never a bad thing. It creates innovation. It creates new categories. So yeah, we absolutely want to see.
So you're in Alexandria, Virginia right now. You're close to the U.S. Capitol. Are you able to lobby? Are you able to communicate your concerns to Washington, D.C.?
Oh, for sure. In fact, I'm part of CraftCo is a part of Discus. I sit on the Craft Advisory Council. I'll be at the Discus annual conference here in a couple of days, Wednesday through Friday this week, and there certainly is an active effort underway to get to Capitol Hill and say, listen, we fully support the objective to protect people, to protect jobs, to be America first. We absolutely support that. What we're looking out for here is jobs, economy, innovation, trade, relationships, and the long-term health of the industry as a whole.
Allie, what can you tell us about the consumer and consumer strength at this point? And maybe, I don't know, it's a case of what the consumer was feeling at the beginning of the year and what they're feeling now, if you're noticing any change.
Consumers, they drive what we do, right? Consumers are all about preferences. When lifestyle shifts happen, I think that's something that challenges us to respond. I mean, we are consumers ourselves. And so often I can speak for my company when we're sitting around the table and we're trying to figure out what could be the next great thing. We did this several years ago with a product we have called Cigar Blend. We were the very first at Joseph Magnus to bring that to market. And that really was just born of things we like, right? What do we want to see in the market? And so today, I think the customer is saying, what do you have for me? What do you have that's different? What do you have that fits my lifestyle?
Right.
How can you dazzle me, right? Keep me interested. So they're very, very savvy. Everybody does a ton of research today.
Right.
And we're thankful for it. They keep us on our toes.
Just quick to follow, but in terms of actual consumer demand, are consumers slowing down? Or are they being pinched and only got about 25 seconds? Are you seeing any signs of that? Yeah.
We are seeing a little bit of a slowdown. Like I said, we call it normalization, but we're seeing consumers make not worse choices. They're actually making very healthy choices. They're all about quality and not quantity now.
All right, going to leave it there. Great to get some time with you. Thank you so much. Allie Anderson, she's Chief Executive Officer of CraftCo, joining us from Alexandria, Virginia.
Hey,
Doug.
stocks rallied today. The S&P 500 up 1.8%, the NASDAQ Composite up 2.3%. Signs that the U.S. tariffs will be more targeted than anticipated, reducing the appetite for safety. Oil climbed as President Trump said he would seek a 25% tariff on nations buying crude and gas from Venezuela. Doug Ciocca has been watching this closely, CEO and partner at Kavar Capital Partners. Got approximately $1.5 billion in assets under management. He joins us from Leawood, Kansas. Doug, we got your notes early today before we really saw this session take off. And you argued that there was this TIP, Tariff Implementation Paralysis. It seems like markets have gotten past that today.
Yes, thanks, Tim. It's a fluid situation, like you said. I think we hit the pressure release valve today based on Friday afternoon's announcement that was corroborated over the weekend that the maximum impact of the tariffs might be a little less than the market had been pricing in. But this TIP, Tariff Implementation Paralysis, is a real thing. I mean, you're talking about sectoral tariffs, secondary tariffs, reciprocal tariffs. Oh, and we're couching those within whether they are national security variety or the trade war variety. So there's a lot of cross-pollination of tariffs that led to a lot of investor consternation for sure.
So do you view today's buying, Doug, as a good sign or just, all right, things have been beaten down a lot. Let's just do a little bit of tiptoeing back in. It's not like we were up 4, 5, 6, 7%. So it does feel like to me that there's still some investor hesitation, but it definitely had a positive tone. How do you read what we got in today's trade?
Yeah, that's a great question, Carol. And thank you guys again for having me on. Like, if you think about our financial markets and the economy, right, they're dynamic systems, right? And as such, they're constantly evolving. But the most basic characteristics of dynamic systems are 4 things, right? 1, stability. 2, instability. 3, oscillation. And 4, chaos. And I think when we're in chaos mode, within which the current administration seems to exist very comfortably, then in general, you want to abide by a few different guiding principles. 1, focus on valuation and not on price. Right, just because a stock falls from 450 to 220 doesn't necessarily mean that is a cheap stock. It might be a very judicious re-rating given the underlying context where we think those profits may grow over a period of time within the prevailing economic environment. Number 2, focus on rebalancing, right? The market got so oversold, and you guys have talked over the last couple of weeks about some of these sentiment indicators and how quickly they've reversed course, like head-snappingly quickly. We went from everything's awesome to we're near an Armageddon scenario. So that gives incredible opportunities to rebalance when things get oversold like they have, which can lead to a lot of buying interest culminating in a single session like today. And the third thing you want to do, this is particularly for wealth management clients like those at Kavar Capital, is embrace the context of a financial plan and how you can take opportunities to adhere to that, given the shifting dynamic system within which we're navigating on a minute-to-minute basis, right? In general, I was saying this to Paul, Trump is turning investors into day traders. And when that happens, you're going to see price gaps that, with the long-term perspective, are going to offer awesome entry points.
When do you think that's, like, how do you see that playing out here? I mean, do you see that we're going to see more volatility ahead, despite that it seems like confidence is kind of back?
Oh, without question, Tim, without question, we're going to see a lot more volatility, right? Because you also have to keep in mind, this is taking place after 2 incredible years in the S&P 500, consecutive years in the S&P 500, right? We needed to have a little bit of a shake up of optimism and sentiment in the environment. We needed a little bit of re-rating that would keep people's expectation more in line with reality. So I think it's a process. There's so much emotion attendant to this environment. I think it's obscuring what is an otherwise economic decision-making system by investors, that it's throwing a lot of it up in the air in a single few, let's say 3 or 4 week session, 3 or 4 weeks of sessions. As it assimilates, that volatility may dissipate, but ultimately it's something we need to brace for throughout, I think, the bulk of the first half of the year.
So if we go by this tariff implementation paralysis, Doug, and if investors are shrinking their time horizons, can we shrink it so far down that the U.S. market, something Tim asked one of our guests last week, that the U.S. market becomes uninvestable?
No, I don't think so at all, Carol. I think, if anything, this TIP is making the market more investable. But break it down by asset class. So within stocks, right, lengthen the time of your deployment out of respect to the expectation of ongoing volatility. Capitalize on the persistence of price dislocation. Focus on the destination, not the journey. We're all told, oh, don't worry about the destination, it's the journey that matters. When you're making investment decisions, it's the destination that matters. So there's going to be some gruelingly volatile sessions, but ultimately I think this economy arrives on firmer footing, so it becomes that much more investable with every extended period of dislocation. For bonds, right, that's really challenging right now, right? We had the opportunity to extend some duration after the Fed began cutting rates last fall, which is a little bit perverse and counterintuitive. But now, because of the equity volatility, you see a massive rush into fixed income. So that duration extension potential has really been contracted. It just doesn't exist as much as it did. And then you have the administration. And there was a great piece in Bloomberg over the weekend that was written by Liz Capel McCormick and Ye Sheye that talked about the Besant put. Right, the Besant put is a real thing, right? Where this administration is going to try to suppress interest rates with energy efficiency, with reducing the number of auctions at designated dates, which is going to suppress demand, which is going to increase price and lower yields. And then also the result of some spending cuts should they extract any through this DOGE initiative. So there's really good opportunities in fixed income, but I think it's going to become more and more challenging, over a period of time, because I don't see rates really running and spiking and the yield curve getting super steep anytime soon.
One last question I want to ask you, Doug. What is the cost, though, potentially of tariff policies pushing back on allies, upsetting and possibly upending the global supply chains? We talked about maybe levies or costs on Chinese ships and the impact that could have on the global supply chain and global shipping. Right. I mean, none of this goes unnoticed by the U.S. economy potentially, and a lot of it can be inflationary. What is the potential impact so that the U.S. market becomes a hard place to invest in just got about 30 seconds?
Yeah, I think those are really big questions, Carol, because I think in a worst case scenario, which would be the U.S. orchestrating consecutive unforced errors, it does then lessen the attractiveness of foreign capital to come into our markets, which becomes problematic. Now, the onshoring, the reintroduction of manufacturing in our economy is going to happen. It's just a longer process. So I'm hopeful that kind of the underlying forces of collective profit-seeking self-interest globally will overtake sort of the short-term initiatives of the new administration.
All right. Always good to check in. Doug, be well. Doug Ciocca, CEO and partner at Kavar Capital Partners, joining us from Leawood, Kansas, about $1.5 billion in assets under management. This is Bloomberg.